If ever there were evidence that very low interest rates in QE don't work, it is in Japan. Japan's inflation rate has been on the floor for most of the last quarter century. So have its interest rates. And the Bank of Japan has been doing QE longer than any other central bank. Its first experiment with large-scale asset purchases was between 2002 to 6. The current governor of the Bank of Japan, Haruhiko Kuroda, is throwing everything he has at Japan's lowflation problem. The Bank of Japan is buying up Japanese government bonds as fast as the government can issue them, and is also buying corporate debt, ETFs and REITs. The interest rate on excess reserves held by banks is negative. But Japan's lowflation remains as intractable as ever. Early in 2018, Japan's inflation reached 1.5%. It appeared that the Bank of Japan had defeated the lowflation enemy. Markets joyfully anticipated the end of QE and the prospect of higher interest rates. After 20 years in the wilderness, the prodigal was coming home. Though they did wonder how it would live in the future, since the Three Arrows program seems to have cost its entire inheritance. How on earth would the Bank of Japan unwind all those asset purchases? And how will the Japanese government pay off all that debt? But their joy, and their concern, was premature. Since April, inflation has tailed off again, along with any possibility of monetary policy, normalization, as central bank watchers like to call it. Though since Japan's interest rates have effectively been zero since 1995, we have to wonder what normalization would even mean. Surely, after this length of time, zero interest rates are normal. This, in a nutshell, is Japan's problem. After such an extended period, expectations of zero inflation and zero interest rates are firmly baked in. Anyone under 40 has never really known anything else. Shifting these expectations is a Herculean task. No wonder inflation has proved ephemeral. The Bank of Japan's explanation for Japan's evaporating inflation shows just how difficult it can be to raise inflation expectations. In ordinary English, this means that when prices start to rise, Mrs. Watanabe cuts spending. So firms don't raise prices, and because they don't want to squeeze their slim profit margins, they don't raise wages either. Mrs. Watanabe's income remains stagnant, so she remains hypersensitive to price rises. It's a demand-deficient feedback loop that traps inflation on the floor. The Bank of Japan admitted that raising inflation to the 2% policy target was taking much longer than it expected. But the Bank of Japan is not throwing in the towel just yet. Yesterday, it pledged to keep interest rates at their current, extremely low, levels for an extended period of time.